Okay, let's get back to after buy side. We talk about the types of financial assets that the sell side investment banks are selling and the buy side institutions are buying. This is a very important slide because it can resolve a lot of your questions about the different names of the financial assets. Mainly speaking, our financial assets can be divided into bond, stocks, and alternatives. What is bond? Bond is basically a contract about borrowing and lending. I want to borrow money, so I issue a bond to you. And this bond is a contract saying that I borrow $1 million from you, you give me the money, and I will give you back how much money, at what interest rates, at what time. For example, a bond can say, I borrow $1 million from you, from an investor, and I give you back $1.2 million in 3 years. And at the end of the first year, at the end of the second year, and at the end of the third year, I will give you $100,000 for 3 times. And this $100,000 are called coupon. It's very different from the coupon that you use to buy to get a discount in the supermarket. Okay, so it's a different concept. So a bond is a contract saying how much money the investor gives to the bond issuer and how much money at what time and how many times that I have to give the investor back, and how much money and how many times at what time. So the 3 years will be called a maturity. Okay, a maturity date. So this bond will mature in 3 years. Because whenever a bond investor is buying a bond, you give him money in exchange for the bond contract, in exchange for the future income. This income is relatively fixed. Why do I say relatively? Because if a bond issuer is going bankrupt, you won't get the money back. But in most of the cases, the bond issuer will be alive, will be still existing. So as a bond investor, your income is fixed. So the bond is also called a fixed income investment. Fixed income. Stocks are different. You give $1 million for 500,000 shares of a company's stocks. You have no idea how much money you will get in 3 years. Actually, you have no idea how much money you will get tomorrow if you sell the stocks tomorrow. So you cannot call the stocks fixed income. It's not a fixed income. You only call it equity. Equity means ownership. You have a share of this company's all assets. Okay. So bonds are the largest financial assets in the world, in the financial world. Stocks. Then all of the other types of financial assets can be called alternatives. If you want to know all of the different kinds of alternatives, you should take the qualification exam and get a CAIA. It's alternative investment analysts. Okay. Qualification. It's pretty difficult. There are mainly 7 kinds of alternatives. Hedge fund is a fund, but hedge fund is also an alternative investment asset. Hedge fund is a company, yes, but the hedge fund company is managing different hedge fund. A hedge fund is a portfolio. Well, it's managed by the hedge fund manager, and the portfolio's components can change, but still a still a investment target. So you can buy the hedge fund. You can buy the hedge fund, a part of the hedge. Similarly, you can also buy the private equity shares. The private equity has a target. Say, hey, we are investing, for example, private equity is doing the LBO. I borrow money, okay, and I invest in this. I take the public company private and I manage it. As an investor, you can buy this share of private equity, okay, and also you can buy the share of private equity company. The third type is called futures. Futures is a standard form contract for the forwards. So futures are this type of assets. It's more like a gambling a little bit. So I want to buy some steel or iron or some other mines. I need them in 3 months. If I buy them today, I need to store them, pay for the inventory and everything. So I want to buy the mines, the iron or the steel in 3 months. But I really don't know the price of this in 3 months. So I want to negotiate with someone. Say, how about I just buy the steel with you, from you in 3 months, and now we settle the price. This contract, this buy and sell in the future contract is called a future. Well, sometimes it's called a forward if this contract is not standard. If the contract is standard, it's called a future. From the buyer's perspective, the risk, the uncertainty is that the price will go up in 3 months. From the seller's perspective, the risk is that the price will go down in the future. So both parties want to minimize the risk. So both parties just say, hey, this price can be accepted by both of us. How about we just sign the contract now? So this contract is is future. So this future, remember what I said in the first part of this video. This future, this financial asset, minimizes the uncertainty, minimizes the risk, minimizes the information asymmetry about the future. So it provides value, okay, and make the transaction possible, and it generates more welfare to the society. Why is that? Think about this. As a buyer of the steel, I probably want to produce some machine. I want to produce some products that can be beneficial, can be useful to the society. But if I'm doing the preparation now, I'm worrying that in 3 months, the price of the raw material, the steel, will be too high. I will lose money. Without the futures, without these financial assets, I would not make the investment now. I would not do the preparation for this factory. So I would not make the production. Okay. With the futures, my uncertainty is minimized. So I will set up this factory, set up everything, and wait for the steel to come into my factory in 3 months, and I can do the production and settle the cost and the market price of my product in 3 months. For the whole market, for the economy, we get more products from this person. Without futures, this steel transaction cannot be made. This production of these products cannot be made. Another one is called option. An option. Option is that I want to buy these stocks, but I don't want to buy it now because I buy it. If I buy this stock, the stock price will go down. I will lose money. So option is a financial asset that gives you exactly the term option to buy this stock in some future day or within some future day. That's called American option. In some future day at the time point, the specific time point is called European option. So you have the option to buy the stock if the stock price is going up. You have the option to buy this stock at the pre-settled price. If the stock price is going up, you gain the difference. If the stock price is going down, you give up the option. I do not buy. I do not exercise this option. I do not lose money. As expense, you have to pay for this option. This is also a contract. Commodities. Commodities is easy. Commodities are the present commodities, not the future. Commodities. Future is about our buy and sell of some commodity, iron, steel, in the future. Commodities are just what we buy and sell today. You probably don't know that there are a lot of commodities markets. And I recently visited some markets, the commodities markets for facial masks. So the price of the masks, this commodity goes up way higher than the past. The sixth types of alternative is called REITs, or real estate investment trusts. This is also to facilitate the investment. For example, as an investor, I have very good faith for the, say, Shenzhen's or Hong Kong's real estate. I think the Hong Kong's real estate price will go high in the future. But Hong Kong's real estate price is too high. Okay. Cheap ones will be $10 million, Hong Kong dollars. 20, 30, 40, 50 million dollars. I don't have enough money. So what do? The REIT companies provide the service, kind of like the mutual funds. They collect a lot of people's money and use so many people's money to buy the real estate and distribute the money to the different investors according to their shares of these REITs. Of course, the managers of the REITs will charge some fees. This is more like the mutual fund. FX, foreign exchange, in short, FX. Currencies, sometimes it's called currencies. Currency or foreign exchange is also another financial assets. In floating foreign exchange rates, the foreign currency's value is changing over time. So if you think Australian dollar is going up and Hong Kong dollar is going down, you want to exchange your Hong Kong dollar for the Australian dollar. So money itself is a commodity. Okay. In the last slide, we talked about FICC. Here, FICC is trading assets. FICC stands for fixed income instruments, the bonds and other bond-like instruments, currencies or FX, and commodities. Let's take a break.